Everybody's heard it before, but the revisions are absolutely nuts for the data that we're getting, including jobs data. Every single time we get jobs data, it gets revised down. This is common of a declining market and sort of economy, rather. But what is now the problem that the Wall Street Journal is suggesting with economic data? And apparently that data is getting even worse. And what could that mean for us as investors? Let's find out. Investors are often wildly overconfident about what's going to happen. They hope for new technologies that push stock prices to extreme highs, or for stories of impending doom that drive them to extreme lows. But even wise investors are prone to buying into narratives about the current state of the economy that turn out to be deeply flawed. Revisions to economic data are widespread and normal, but occasionally the revisions are so big that they upend our shared understanding of what's actually going on in the economy. In the latest example from the United Kingdom, where it turns out the economy grew much more than previously estimated. Rather than being the stickman of Europe with GDP still smaller than before the pandemic, and the weakest recovery in the group of 7, it has now beaten Germany and grown in line with France. The problem isn't new, but it's getting worse. Timely data is typically based on surveys, and even companies can't be bothered to fill in surveys anymore. This is true. One of the things that you really realize with surveys is that usually in a rougher economy, businesses feel almost embarrassed to submit surveys, not because they really are embarrassed to fill out this anonymous survey, but because filling out the survey acknowledges the pain. Acknowledging the pain is actually very psychologically difficult. And it's actually sometimes one of the best things that we can do. And I'm not trying to go down the tangent of psychology, but sometimes if we feel depressed or sad about something, one of the best things to do is lean into it and think about all possible scenarios about how bad something could be to find out, wait a minute, those things that I thought were really bad maybe actually aren't that bad, or maybe there are actually hidden opportunities in that. Or maybe there's a reason this is happening, right? But generally, that's not how we as humans think. We try to recoil from bad news. So survey results actually disappear, become less functional because less people are responding to surveys. Early reporting figures that are later revised away can send investors in entirely the wrong direction. It can embed an understanding of the economy that takes a long time to be corrected. At worst, it can lead to a misallocation of capital and influence government policy or interest rates. I personally believe that's exactly what's happening with the bear narrative. That there's this belief that, oh my gosh, inflation's going to stay high forever, and that earnings are going to crash, and that we're going to go into a deep, dark recession, and the black swan's going to kill everyone. Well, the reality is you should probably be considering that we're in a volatile Nike swoosh recovery. I've been calling this for about 12 months. It's been correct. I expect it to continue to be correct. That doesn't mean I'm always right. I definitely make mistakes, but I think this perspective is accurate, and so far everything continues to reiterate that. And we'll see when things change. Obviously, we'll revise. But so far, this is what's been happening. But this is right. I mean, the Wall Street Journal here is arguing that you have to be careful about misallocating capital based on potential wrong information. Markets don't tend to react to revisions, and especially to revisions like we've just had to GDP, because your average trader or investor is interested in what's the latest data, not what happened previously. Or still, people cling to the idea that numbers are accurate. No, they're not. This isn't only a problem for investors in the UK, where the $3 trillion economy is almost 2% bigger than previously thought. Investors in the US have been wrong-footed about the jobs market this year, which has turned out to be much cooler than expected, which is actually, to some extent, somewhat bullish, because it means the Fed can relax. Some of the surprise was simply that economists predicted more jobs would be created than in fact were, which is the normal uncertainty about the future that investing is all about. But revisions contributed, as initially strong jobs figures were later revised down sharply, with 250,000 fewer jobs created over the past 6 months than previously thought. I actually think that was up to 300,000 fewer previously jobs created. It turned out to be good for stocks, reducing the pressure on profit-sapping wage increases and easing the need for higher rates. Exactly. 3 examples show how this can matter a lot for policy as well. The labor market in the summer of 2011 appeared to have stalled, the Bureau of Labor Statistics reported zero jobs growth in August of 2011, which is really interesting because the fall of 2011 was often seen as the bottom of the market, the bottom of the real estate market. Wall Street Journal reported on the figures, was headlined, "Job growth grinds to a halt." Stocks fell more than 2% that day. The truth was actually the opposite. Later revisions showed that new jobs were being created at a healthy clip of about 130,000 per month. It's crazy. It's at the inflection points that the data is most inaccurate. So it's probably weaker now than the data is reporting. But when it starts inflecting up again, that'll also occur with a substantial lag. In Britain, at about the same time, fears grew of a triple-dip recession. Oh my gosh. In the end, the third recession never happened, and the second recession, defined as 2 quarters of falling GDP, was revised away. It turns out, rather than shrinking 1% over 3 successive quarters, there was only 1 quarter of a downturn. See, this, by the way, is why it's hard to be bearish for the long term, because usually economies just strengthen over the long term. Then there was the first quarter of 2015 when the U.S. economy, according to the Wall Street Journal, slowed to a crawl with growth of just 0.2%. This is, by the way, when we were lowering our inflation targets. That was later revised to a fall of just 0.7%, although the Fed blamed it on transitory factors. Oh, that's actually comedy, which turned out to be right, though, and growth subsequently revised up to 3.3%. And what's actually comedy about this is the transitory inflation narrative will probably end up being correct in the long term. We'll look back and go, well, of course it was transitory. Investors should brace for more of this. Shifts such as working from home and new job categories like social media influencers, oh, I wonder what that's like, aren't captured in much of the data. The timely data that drives markets on a day-to-day basis has become less reliable. The response rate for surveys has been behind at about just 60% before the market, 60% before the pandemic, now just 42%. It's even worse is the JOLTS data to find out how many vacancies and how many people are quitting in terms of these surveys are also flawed because the response rates are super low. Look at that, just 32%. Investors should be aware of this uncertainty and try to back up any position based on economic data by checking other data and surveys. Right. This is why you can't just look at one piece of data. And that's why, I'm not here to try to say stocks can only go up, it's the bull narrative. It's just when we take everything as a holistic view, which we do every single day, we're sitting here every single day understanding the market, not just data-wise or chart-wise or stock-wise or earnings call-wise, but earnings reports and talking to business owners, talking to real estate investors, talking to landlords, talking to realtors, talking to, executives at companies or companies, investor relations staff. All of this together just indicates that companies aren't actually planning for a recession. That's sort of the edge right now. It doesn't mean we can't get black swan, but yeah, it is true. The data, as it probably more corrects, is probably going to be more towards indicating, hey, Fed, you've done enough. Don't overcorrect, which is somewhat of a bear case, right? This idea that the Fed could overcorrect. Let's take a look at how we're doing on break-evens. 5-year break-even right now sits at 2.29. Somewhat stable since about middle of July. And a little up recently, but stable since the middle of July. 5-year forward sitting at 2.33. And then we can get to the Fed's terminal Fed funds rate. Remember, 5.37 implies no more rate hikes, and any little bit above 5.37 getting to about 5.625 gets us closer to fully pricing in another rate hike. And that number currently is sitting at, drum roll, waiting for the chart to load. It's still loading. Still loading. Okay. We'll wait for it to load. Last we checked, it was somewhere around 5.42 was roughly the high level. I can't get it to load right now. It's probably at a similar level. Here it is. It just came through. 5.43. Similar area. So, anyway, that gives us a little bit of a thought on some of this economic data. And really suggests, hey, don't be too caught up in just one piece of data. Look at everything. Look at everything that's going on.